Sydney market's come off a boom year with about a 20% growth, or just over 20% growth for the last 12 months. And there's a lot of talk of a severe crash sort of coming towards the end of the year. Nothing that we're seeing is indicating that. In saying that, however, the pent-up demand that's been there, probably over the last few years, particularly through COVID, has subsided to an extent, whilst there are owner-occupiers still out there looking for property and transacting as per normal. It's probably not to the levels that we'd seen previously. What we're starting to see now is we're starting to see a lot more investors come into the market, and they're probably making more astute decisions with respect to the prices that they're paying for property. In saying that, we're still seeing strong growth in the top end of the market, and with properties that have development potential or some other intrinsic land value associated with them. As migration sort of returns to normal levels, we probably envisage that the apartment market will start to lift there as well. And Sydney's got one of the strongest apartment markets in the country, so we see that occurring. The regional front is probably a little bit more uncertain. We've seen unprecedented growth over the regional areas, probably in the last couple of years, largely driven by the lifestyle factor, which has been brought to the forefront through COVID. I see that as the greatest risk as things start to return back to normal and people may be forced back into the offices. For me, whilst that's been fairly robust, I have more concerns around the pullback of the regional market than I do within the Sydney market itself. The commercial landscape has been absolutely fascinating. I think when COVID hit, everyone thought it would be absolutely decimated. Whilst there are, a lot of properties on market for lease, on the buy side of things, it is really, really robust. We're probably seeing a bit of a changing of the guard, so the traditional retail strips of fashion and eateries and these sorts of businesses are moving out, and we're seeing service-based businesses move into retail. The demand for purchasing is insatiable at the moment, so there is a huge demand when it comes to the purchase of commercial premises and retail premises, even though the leasing sector is lagging behind for obvious reasons. Probably the shining light, and the one that we're probably the most bullish on, is the industrial sector. Again, an insatiable demand for that product, just due to the wide tenant mix, and again, predominantly driven by owner-occupiers. There is just not enough stock in the industrial sector. Vacancy rates are at all-time lows, and with the emergence of online transactions and online businesses, we see that will continue to be the case into the foreseeable future. On the owner-occupied segment, predominantly we're dealing with medical professionals and sourcing sites for medical professionals. On the lease side, as a tenant, they are in high demand and able to, negotiate stronger terms than a standard tenant. Particularly in light of what happened with COVID, the stability of tenancy is a huge factor now when assessing who they're going to accept as a tenant. So if you're looking at the CBD, for example, you're negotiating incentives anywhere between 20 and 40%, depending on the building and the landlord. But on the purchase side as well, I mentioned before the changing of the guard and services-based businesses taking over retail spaces and really going after the commercial space as well, because of the low interest rate environment making it more feasible for them to buy as opposed to lease. The market's really tight in terms of the purchasing on commercial space and retail space, particularly those spaces that are suited to medical or health-based practices. And we're seeing in a lot of cases having to pay overs to be able to secure a site that is practical for those purposes.